With shares taking a daily dip amid a falling short-term trend and just mixed signals flashing across the board, you really have to ask yourself, is SoFi a screaming buy, a falling knife, or just a classic value trap?
Yeah, that is literally the million-dollar question right now. I mean, you
Hmm.
have fundamental investors looking at it and seeing this generational discount, but then technical traders are looking at the exact same data and bracing for a collapse.
Right. Well, welcome to today's deep dive. We're looking at a huge stack of data on SoFi Technologies Inc. as of April 21, 2026. The stock just closed at $18.83.
And we are right on the wire here because their major Q1 2026 earnings report hits next week, so the timing on this is critical.
Exactly. So our mission today is to unpack those underlying financials, look at the technicals, and decode the market sentiment before that earnings print. But before we jump into the numbers, I need to look right at you, the listener, and ask a quick favor.
Here it comes.
Yeah, look, please like the video, subscribe to our YouTube channel, and leave a comment with your feedback. I mean, it's compulsory if you want us to keep making these deep dives. We genuinely want to hear your bull or bear case down in the comments.
And, just to set our ground rules before we get to the analysis, this conversation is just a natural debate, testing the data we have, we're exploring the mechanics, but none of this constitutes financial advice, right? We're just connecting the dots.
Right, totally. So let's strip away the market noise and just look at the engine room, the actual business. Because, I mean, for full year 2025, SoFi reported $3.61 billion in total revenue.
Which is huge.
Yeah, up from $2.61 billion in 2024. And they pulled in $481.32 million in net income. So their trailing 12-month EPS is $0.39. It's like a startup that finally moved out of its parents' basement and bought a tailored suit, you know?
That's a great way to put it, actually, because $1 billion in top-line growth is a profound shift. They aren't just burning cash on a tech idea anymore, but honestly, the real story, the thing that matters most, is hidden on the balance sheet.
You're talking about the deposits, right?
Exactly. They're sitting on nearly $33 billion in total deposits.
Okay, but help me out here. In a world where tech companies are valued on, like, software margins and user growth, why is a heavy deposit base so critical to the bull thesis?
Well, think about how traditional lending works.
Mm-hmm.
If a standard neobank wants to issue a loan, but they don't have deposits, they have to borrow that money from institutional markets at relatively high interest rates.
Right.
And then they lend it out to consumers at slightly higher rates. So the profit margin is just razor thin.
Ah, okay. But SoFi has a national bank charter.
Exactly. Because of that charter, they can use that $33 billion in user checking and savings accounts to fund their loans. They pay the user a modest yield, lend it out at premium rates, and just pocket the difference. It provides this incredible low-cost funding base.
Okay, that explains the capital position improvements I'm seeing, because their debt-to-equity ratio has dropped to 0.17.
Which is really impressive.
Yeah, and their tangible book value climbed to $5.97, up from $4 a year prior. So the foundation is undeniably strong. But this is where I hit a wall with the data.
How so?
Well, you just laid out this incredibly strong fundamental case, right? Real profitability, low debt, rising book value. But then I look at the 52-week range.
Right, the chart.
Yeah. The high was $32.73. The low is $10.49. And today we're sitting at $18.83, which is the lower half of the yearly range. If the business is so strong, why is the stock struggling so much?
So this is the classic friction between intrinsic value and market psychology. Fundamentals tell you what the business is worth, but technical analysis tells you exactly what the market is willing to pay right now, and right now the tape is just deeply conflicted.
I mean, the short-term trend looks okay, right? It's up over 11% in the last month and nearly 17% in 2 weeks. It looks like positive price action.
There is absolutely a short-term bid stepping in, but it's happening under a massive ceiling. The stock is still trading well below its 200-day simple moving average, which is sitting way up at $23.88.
Wait, I constantly hear people talking about that 200-day moving average. Why is that specific line such a big deal for institutional money?
It's basically the ultimate algorithmic filter. Institutional money managers use it as a blunt instrument to determine the long-term trend. If a stock is trading above it, it's deemed healthy.
And if it's below it?
If it's buried underneath it, like SoFi is, By over $5, risk management systems just automatically categorize it as being in a long-term downtrend. It literally prevents large-scale capital from buying in.
Wow. Okay, so that explains the immediate battlefield we're seeing on the chart. Support is holding at $18.79 based on volume, and right below that is $18.68, which is a key Fibonacci level.
Yeah, the Fibonacci retracement levels are huge here.
Wait, I have to ask, is a Fibonacci level just like astrology for finance, or is there an actual mechanism there?
I know it sounds arcane, but it's really just a map of human psychology. When a stock makes a large move, traders instinctively look to buy pullbacks at predictable percentage drops. And because millions of algorithms are all looking at those same percentages, the orders cluster there. It becomes a self-fulfilling prophecy.
Okay, that makes sense. So we have support holding the floor, but then resistance is pressing down heavily at $19.38 and $19.51.
It's trapped in a very tight box.
Right. But there's a huge warning sign here on April 21. Trading volume was 65.6 million shares on a day. The price fell 3.44%. Isn't a volume rise on falling prices a classic warning sign of near-term weakness?
It is a textbook red flag. Volume is basically the lie detector test for price action. When a stock drops 3.44% on almost 66 million shares, that indicates active, aggressive distribution. Institutions are purposely dumping their positions before earnings.
Taking risk off the table.
Exactly. And they're willing to accept lower prices just to get out.
Jeez. And, looking at the momentum indicators, they are completely paralyzed. The RSI, the Relative Strength Index, is at 49.1, which is perfectly neutral.
Right, the market is just holding its breath, waiting for a catalyst.
And the MACD is flashing totally mixed signals. Some platforms are saying buy, but others are looking at the exact same data and signaling sell. How does that even happen?
Well, think of the MACD like a speedometer. When signals conflict like this, the car is still moving forward, hence that short-term rally, but the driver has taken their foot off the gas.
Ah, momentum is slowing down.
Right, so some platforms see slowing momentum and say sell, while others just see forward motion and say buy.
Okay, so the chart is a literal standoff. So we need to look at who is actually putting their money on the line, the market sentiment, and the discrepancy here is just wild.
The insider buying, right.
Yes. Over the last year, insiders have bought or received $180 million in shares, compared to only $36.9 million sold. That is a massive vote of confidence from the people running the company.
It's one of the strongest signals you can find. They see the daily deposits, the loan performance, the user costs. If they're accumulating equity, they clearly believe it's undervalued.
But then you look at the short sellers. Roughly 13.2% of the float, which is over 165 million shares, is shorted right now. They're betting heavily against it. So how does this play out with earnings coming up?
Mechanically, that high short interest acts like a coiled spring. If SoFi reports weak guidance, the shorts win, and the stock easily breaks that $18.68 floor.
But if they report good news,
Then you get a violent short squeeze. Short sellers are forced to buy back those 165 million shares on the open market all at once, which drives the price up, forcing more shorts to cover. It can be explosive.
and sitting right in the middle of this are the analysts. They have a consensus hold rating 5 buys, 8 holds, 3 sells. But the average price target is $23.35, which is about a 24% upside.
But look at the range on those targets.
Yeah, the range is massive, from $17 all the way up to $38. I mean, that brings us to the core debate. Are buyers getting a massive discount or walking into a trap?
That variance exists because Wall Street literally doesn't know how to value them. Are they a traditional bank or a tech platform?
Right, the valuation paradox. Let's look at the PE ratios. Forward PE is 28x based on projected free cash flow growth, but the trailing 12-month PE is 48.8x.
Exactly. For a tech company, a 28x forward multiple is a bargain. But for a bank, 48 times trailing earnings is a massive value trap. The bulls are paying for the future, and the bears are anchored to the past.
So let's build the bull case, the best case recovery scenario. They have 13.7 million members, which is up 35% year over year. 2026 net income guidance is $825 million, a 72% jump.
Huge numbers.
And crucially, their fee-based tech platform revenue is up over 50%. Why is that specific metric so important? Why does it reduce their reliance on risky lending?
Because it completely rewrites the risk profile. SoFi owns the back-end digital infrastructure for other fintechs. Every time another company uses their tech to process a payment, SoFi collects a fee, it scales infinitely, it's high margin, and there's zero credit default risk.
Ah, so it's a software play.
Right. But the bear case, the worst case continuation, is that they aren't fully a software company yet. They still have heavy exposure to personal loans.
And what's the specific danger there if a recession hits?
Unsecured personal loans are the very first thing consumers stop paying when money gets tight. There's no collateral. Bears fear that a spike in default rates could wipe out that $825 million in projected net income overnight.
Ouch. And that brings up the volatility. The data shows SoFi has a high beta of 2.32, making it more than twice as volatile as the broader market. Plus, there's rising pressure from traditional banks and neobanks.
It's incredibly choppy.
Is this high volatility exactly why retail traders often get trapped? Like, they buy the dip, get chopped up by the swings, and panic sell before the underlying fundamentals can even play out.
That is precisely the danger of the retail trap. A trader buys at $18.83 for the long-term tech transition. But tomorrow the market drops, SoFi drops twice as hard, it breaks a technical support, and they panic and sell for a loss.
Right, they get shaken out.
Exactly. They get distracted by the waves and forget to check the engine room.
Wow. We have really unpacked a lot today. The rock-solid numbers, the precarious chart, the whole debate between bulls and bears. So what actually happens next? What's the short-term versus long-term outlook?
Short term, it is highly precarious. It largely hinges on the Q1 2026 earnings report on Wednesday, April 29, before the market opens. That will dictate the immediate direction.
And long-term?
Long term, it depends entirely on whether they can outrun their credit risks by scaling that tech platform. If they can execute on the software side, the legacy banking risks fade into the background.
Man, it is such a fascinating setup. Well, I want to leave the listener with a final provocative thought to ponder before earnings.
Let's hear it.
Given everything we've just unpacked about SoFi's volatility and this massive transition to a tech platform model, how does their valuation truly stack up when you compare it to successful peers like New Holdings or PayPal?
Ooh, that is the perfect question.
Right. Are they a mispriced underdog or just weighed down by legacy lending? I highly recommend you all go look into those comparisons. But that is all the time we have for today. Thank you so much for joining us on this deep dive.
It's been great.
Don't forget to jump into the YouTube comments with your own bull or bear thesis. And again, this was an exploration of the data, not financial advice. We'll see you next time.